Hi, I'm Pattu from freefincal. As I interact with young readers these days, it's clear to me that many of them are very overconfident about their equity investments. In fact, generally, investors have been um, confident about the equity market since late 2013 onwards. In fact, after the recovery post the March 2020 crash, from the recovery onwards, this confidence has somehow seemed to turn into overconfidence, and today people are so sure that their returns are just going to be the same forever into the future. I hate to break it to you, but there's really no proof that long-term equity investing will always give you good returns. People always say long-term equity investing will give you good returns. If you ask them for proof, well, they will just give you the graph of Sensex since inception, the graph as S&P 500 since inception, and so on. That is not proof. That's just one data point in terms of returns. There is really no proof that long-term equity investing will give you good returns. I've made videos about all these articles that I'm going to show earlier. You can check them out in the channel. So the stock market always moves up in the long term, but if you look at the returns, it will move up and down. For example, this is the Sensex price index from 1979. This is the log scale of the same graph. And but if you look at the 15-year rolling SIP returns of the Sensex, of course, you can add 2% for 2.5% for dividends and so on. You can see that it has been up and down, and it has actually been trending downward. So you can see that I don't think you're ever going to see 25%, 20, 30% on all or that kind of returns that we saw in the past. That was the time when the markets were severely manipulated because of the Harshad Mehta scam and so on. I don't think we're going to see that kind of returns. So already the returns are falling down, and you can see them, they are moving up and down. If you look at the Sensex, if you look at the S&P 500, where you have a lot more data, this is the graph from 1900 to 2021. Of course, I have not updated these results, but the spirit of the results are not the same, are going to be the same, excuse me. So this is the log scale S&P 500, and you can see it's moving up. That doesn't mean your returns are always going to go zoom up. So you can see this is an exponential increase of the S&P 500. But if you look at the 15-year rolling SIP returns, there are 1,333 data points here. You can see how much they have been moving up and down. If you ask, have they given you real returns in terms of beating inflation? Typically, yes. The answer typically yes, but not always. So, um, the lesson that one should take is that equity is likely to beat inflation, but that doesn't mean you will beat inflation. The point I'm trying to make is, if you go back to Indian data, so the green dots, the light green dots are the PPF interest rates. The crosses are the 15-year average of the consumer price inflation. Typically, it's a good idea in India to set our inflation estimate as equal to that of the PPF rate. So if you look at the PPF rate and compare it with the 15-year rolling SIP returns from Sensex, you add 2% for dividends. You can see that most often, except for a few occasions, the Sensex has bet the PPF. So that means I can say with reasonable confidence that the equity markets will beat inflation. However, if I'm talking about inflation of 7%, 8% maybe in the last couple of decades, if you take set it to PPF rate, people today want 14% from equity, 12% from equity after tax. That there's no guarantee that if you go above these green dots, the fluctuations become very high. You don't know what you will get. So just because the equity market has bet inflation doesn't mean you will beat inflation, because you have set your target return to be so high that you equity returns may fall short of your estimate. So there is really no proof that long-term equity investing will always give you good returns. Good returns means they are returns that you expect, right? So all these arguments about economy growing, therefore equity market will reflect those returns, they're all bullshit. They're all peddled by sales guys. These ignorant influencers parrot these ideas, and then they're made into legend by people, by lazy, naive investors. So that's just nonsense. So yeah, like I said, equity gives you a reasonable chance of beating inflation. Now I want to make it very clear that I'm not against equity investing here. I'm all for equity investing, but I'm just saying don't be overconfident. In fact, don't even be confident that equity will always win. That's not, there's absolutely no guarantee of that kind of thing happening. So, as I make this video, close to 60% of my family's net worth is in equity, and more than 80% of the entire net worth is market linked, thanks to mandatory NPS contributions, etc. So, I'm just saying, be cautious. Just don't try to assume that oh, you got 5 years I got this much return, 3 years I got that much return. That doesn't mean you're going to get that in the future. That's just not going to happen. And that happened to me. For example, after the March 2020 crash, my 12-year portfolio, equity mutual fund portfolio, crashed to 2.75% total XIRR. So it can happen to anybody. And people say, oh, no, it's because you picked the wrong funds. I mean, how will you know what is the right fund to pick in the future, right? That's just silly. Now, it is very important for readers to appreciate, viewers to appreciate that there's something called volatility bunching in the markets. That is, whenever there is a sharp increase in price, there will typically be a sharp decrease in price, and vice versa. So you don't need to worry too much about, you know, bang, big crashes, that just make the prices fall banging, crashing down by 30%, 40%, etc. Typically, the recovery should be reasonably quick. Typically, not always, again, not a guarantee. But what can happen afterwards? We saw that happen in 2008. We saw this happen in 2020 as well. There will be a slowdown. There can be prolonged economic slowdown. There can be uncertain political climates. There can be war, etc. If you look at our lost decade, we had a lost decade in the 1990s where the Sensex did not move up. That was a decade where the government was bankrupt. It was on the brink of bankruptcy, and it was recovering from that as the economy opened up. But we also did not have a stable government in for many years in those times. So, how long will it take for us not to have a stable government again? We can have a in the next election, we may not have a stable government. We may not have a majority. We don't know, right? Anything can happen. I'm not saying that will happen or this will happen. I don't know. So you can never be sure that when you start investing, you will never encounter political uncertainty, poor economic growth, wars, other crises, etc. So anything can happen. So, although there is a broad correspondence between economic growth and equity market growth, that doesn't mean it would be your specific experience. For example, people here, if you look at this graph, oh, look how the Sensex is zoomed. But if you look at the returns, some people have got very high returns, some people will get low returns. That is the essence of sequence of returns risk. And we studied the 44-year history of Sensex, and it's the 44 years return. Overall return since inception is about 17%, including dividends. But half of those returns came from just 4 years. 4 good years determined it. The rest of it, 44 years, and 4 years determines half of those returns, right? That's incredible. So, which means that most of the return of years will not be as rewarding as the best years. So you have to be patient. You have to wait for those bumper years, and you have to be calm and not be overconfident, thinking that I will always get it, that I can manage whatever how much ever the equity market crashes, I will I will handle it. I'm emotionally stable and all. I mean, unless you have actually seen it happen, I think it's just it's silly. And regarding the boom in the mid cap funds and small cap funds, this is, I mean, come on. We've talked about small cap funds particularly. There's really no evidence that you're going to always get those spectacular returns, right? Whatever they gain, they will quickly lose. And if you look at the long term returns of small cap funds today, long term means beyond 5 years. That was before the year 2008 where the SEBI mutual fund categorization rules kicked in. So before that, those rules came into play, many small cap funds were mid cap and small cap funds. So they had significant chunks of mid cap stocks. So so the long term returns that you're seeing today, mid cap stocks have a role, have a contribution in those long term returns. And we saw recently that the small cap index constantly underperforms the mid cap index. So from now on, from the another next 5 years, so from 2018 to 2028 period, you will have a period where mostly small caps will dominate the portfolio. How will that fare? We don't know. So we can't be overconfident. I keep saying this again and again. Equity is like fire. Fire is indispensable to our lives. But if you get comfortable and start fooling around with it and get overconfident with it, it will burn you. So always take what the mutual funds tell you seriously. I mean, tell you in their disclaimers. Take those disclaimers very seriously. They tell you that um, the past performance is not a guarantee of the future performance. That means that you cannot look at those returns in the past and say that's what the returns I'm going to get in future. That is simply not going to happen. We need to have a proper de-risking strategy. I've talked about the de-risking strategy in several places in the podcast and previous videos and several articles and so on. You need to have a proper asset allocation. You should have low return expectations. You should have good diversification, and you should have a equity tapering down strategy so that you can achieve your goal regardless of future market conditions. So please don't be overconfident or confident in equity. You have to assume that your returns will drop and you will get lower returns than what we have seen in the past.